Chicago was broke. Not metaphorically, mathematically. The kind of broke where you start selling the furniture just to keep the lights on. So in 2008, the city found a buyer for one of its last reliable moneymakers, parking meters, 36,000 of them, every nickel, every quarter, every expired ticket. And the buyer wasn't some Wall Street shark or hedge fund cowboy. It was Abu Dhabi. While Chicago was scrambling for short-term cash, someone 7,000 miles away saw something else, a compounding asset with a 75-year yield. They didn't invade, they invested. And in a single deal, they locked in returns that most governments would envy. Because while politicians chase election cycles, sovereign funds play centuries. This isn't a story about corruption or conquest. It's a story about discipline, about vision, about a city that sold time and a nation that knew exactly what it was worth. This is how you turn desperation into dividends. This is how Chicago sold its soul and Abu Dhabi made interest. Chicago in the late 2000s was a masterclass in municipal triage. The Great Recession had ripped a hole in its budget, but this was merely the final acute shock to a system already bleeding from decades of political sclerosis. The city was a patient on the table, its fiscal veins collapsing. Pension obligations promises made in sunnier economic decades were now metastasizing into multi-billion-dollar liabilities. The city wasn't just cash poor, it was structurally insolvent, trapped in a feedback loop of service cuts, tax hikes, and bond rating downgrades. So, City Hall did what any desperate household would do. It started looking for things to pawn. Not the crown jewels, those were long gone or untouchable. No, it looked at the municipal equivalent of the silverware. Public assets. The parking meters were perfect. They were mundane, ubiquitous, and generated a predictable, if unglamorous, stream of cash. They were in the eyes of a government thinking in fiscal years. Just furniture. The logic was seductively simple. Monetize an existing static asset to plug a dynamic, growing liability. It was a short-term fix for a long-term cancer, a financial Hail Mary passed from a collapsing pocket. The political calculus was even more elegant. The $1.15 billion upfront was just a number, it was a stay of execution. It meant avoiding teacher layoffs, or filling potholes, or crucially avoiding a tax hike right before an election. It was a transaction designed to solve a political problem, not a financial one. The 75-year consequences were an abstraction. The next election was a certainty. They weren't selling the future, they were renting political stability, and the meters were the collateral. The deal was struck with the frantic energy of a back alley transaction, dressed in the sober suit of a municipal bond offering. In 2008, Chicago Parking Meters LLC, a consortium spearheaded by Morgan Stanley, but fundamentally bankrolled by the Abu Dhabi Investment Authority, cut a check for $1.15 billion. To the city council, this was a miracle. It was a number large enough to paper over the budget cracks, and for a blissful news cycle, looked like genius. They approved the 75-year lease in a matter of days, a blink in the timeline of the commitment they were making. But the devil wasn't just in the details, it was in the discount rate. The $1.15 billion figure was a political number, not a financial one. It was based on a low, stagnant projection of future meter revenue, a conservative model that failed to account for inflation, population growth, or most critically, the city's own power to modernize the system. The contract itself was a masterpiece of constraints, handcuffing the city from improving public transit or removing meters without paying staggering penalties to the owners. They had not only sold the cash flow, they had sold their own operational sovereignty over public space. The true irony, the beautifully savage twist, was what the city did with the windfall. They didn't invest it. They didn't seed a sovereign wealth fund of their own. They used it as a plug, shoving the capital directly into the gaping maw of annual operating budgets. It was like selling your family's farmland to pay a single year's credit card bill. The money was consumed, leaving behind no productive asset, only a 75-year void where a steady revenue stream used to be. They solved a 2-year problem with a 7-decade solution. A masterclass in political arithmetic, where the unit of time is never a generation, but a term. While Chicago's politicians were counting the stacks of short-term cash, Abu Dhabi was reading the fine print, and they liked what they saw. This wasn't a predatory move. It was a pedagogical one. They were graduate-level investors applying their philosophy to a distressed American city. The Abu Dhabi Investment Authority doesn't think in earnings reports or election cycles. It thinks in epochs. Its mandate is to transform finite oil wealth into infinite financial liquidity. And to do that, you need assets that are boring, durable, and immune to the whims of politicians. The parking meters were the perfect thesis. They are a toll road on the public square, a tax on movement itself. Recessions come and go, tech bubbles inflate and pop. But in a sprawling city like Chicago, people will always need to park. The revenue stream is arguably more resilient than oil. It's a utility, embedded in the concretes and steel of the urban fabric. ADA saw through the grime and the mundane exterior to the core truth. They were acquiring a miniature regulated monopoly. They weren't betting on Chicago's government, they were betting on Chicago's existence. This is the silent genius of the sovereign wealth play. It is capitalism stripped of sentiment, of branding, of ego. There is no flagship store, no headline-grabbing CEO. There is only the quiet, relentless accumulation of cash flow engines. The meters weren't a trophy asset. They were a cog in a vast global machine of interlocking yields. ADL wasn't buying parking meters. It was buying a piece of the kinetic energy of a world-class city, an energy that compounds long after the officials who signed the deal are forgotten. They saw the 75-year term not as a risk, but as the entire point. It was a time horizon needed for the magic of compounding to do its heavy lifting. Now watch the math do its brutal, beautiful work. That initial $1.15 billion wasn't a purchase price, it was the principal. And over 75 years, the returns don't just grow, they explode. The consortium, with Abu Dhabi's capital as its anchor, was projected to recoup its initial investment in under 2 decades. Every dollar collected after that is pure, untaxed profit, stretching out to the year 2083. We're not talking about doubling their money. We're talking about a multiplier that reaches into the thousands of percent. This is the geometry of patient capital. But the real power move was in the architecture of the contract itself. It wasn't a static agreement. It was a financial instrument engineered for maximum yield. The deal included annual escalators tied to inflation, ensuring the revenue stream wouldn't dilute over time. More ingeniously, it contained clauses that required the city to compensate the owners for any lost revenue, from street fares to new bike lanes to disabled parking spots. Chicago wasn't just losing future revenue, it was actively paying penalties for its own urban development. The system was now rigged so that the city's progress directly enriched its silent partner. This is what a checkmate looks like in high finance. It's quiet, it's contractual, it's irrevocable. While a hedge fund might flip an asset for a quick 20% gain, ADI executed a generational harvest. They planted a single financial seed and structured a system to water and fertilize it for 3/4 of a century. They didn't need to manage the meters, or understand Chicago's politics, or even visit the city. They simply had to own the algorithm of the cash flow and wait. The true masterpiece wasn't in spotting the value, but in designing the vessel to capture it forever. Abu Dhabi didn't just buy an asset. They bought a financial gravity well, and time is bending everything toward their pockets. The hangover was as predictable as it was brutal. Within just a few years, the city's short-term fix became a long-term civic nightmare. The $1.15 billion was gone, spent on the ephemeral needs of a past administration, leaving behind a contract that began to actively strangle the city's vitality. Meter rates quadrupled almost overnight. The city treasury, which once collected a steady, modest stream, now watched as a river of quarters flowed from its streets directly to a Gulf sovereign wealth fund. But the real pain was in the penalties. The contract became a ghost in the machine of urban planning, a financial veto on innovation. Every time the city wanted to create a pedestrian plaza, dedicate a loading zone, or even add a bike lane, it received an invoice from Chicago Parking Meters LLC for the projected lost parking revenue. The city was literally taxing its own progress, paying a private entity for the privilege of modernizing its infrastructure. The meters, once a simple utility, were now a financial instrument that made urban improvement fiscally punitive. The contrast in mindsets is almost poetic. Chicago's government, operating on a political clock, saw a number $1.15 billion that solved an immediate crisis. Abu Dhabi, operating on a generational clock, saw a system, a 75-year revenue-generating algorithm. One side was playing a frantic game of whack-a-mole with yearly budget deficits. The other was patiently cultivating a perennial money tree. The fallout, therefore, was not an accident. It was the inevitable result of a collision between two different conceptions of time. One entity thought in election cycles, the other thinks in civilizations. And in that mismatch, the entire tragedy and genius of the deal is revealed. So what did we learn? This wasn't a heist. It was a seminar, a masterclass in temporal arbitrage, where one party valued the next quarter century. The old world conquered with armies and maps. The new world acquires with contracts and spreadsheets. The UAE didn't need to plant a flag on Lake Michigan. They simply bought the right to tax it. Modern empire is not about controlling territory. It's about controlling the revenue streams that territory produces. Chicago didn't sell its soul to a monster. It pawned its future to a mathematician. And this mathematician's cold calculus isn't unique. It's a standard, unremarkable business of sovereign funds from Norway to Singapore to China entities designed to play a century-long game. They aren't conquerors. They are custodians of generational wealth. While Abu Dhabi was locking down Chicago's parking, Qatar's fund was buying London's skyline, and Singapore was bailing out Wall Street banks. This isn't a takeover, it's just finance at its most disciplined and global. The true villain of this piece isn't a foreign nation, but a domestic short-termism so profound it can't see beyond the next fiscal year. We romanticize the fall of empires as dramatic events, sackings, revolutions, the burning of capitals, but the more common decay is quiet. It's the slow, rational, unforced error, the selling of a perpetual income stream for a single fleeting moment of relief. It's not a collapse, it's a liquidation. And in the silence of a sovereign wealth fund's boardroom, the only sound is the quiet, relentless ticking of a clock set for 75 years. The great game is no longer about controlling the land, but about owning the time that the land produces. City self-stability, investors buy duration. Chicago sold time, and Abu Dhabi knew exactly what it was worth.
To the rest of you, the non-believers, the underachievers, the tweet and deleters, you guys make me sick to my stomach, fam. Honestly, if you guys want to look in my eyes, you guys want to do something? That's what I thought. No, that's what I thought. That's what I thought.